Ladies and gentlemen, good day and welcome to the Q4 and FY25 earnings conference call of Elecon Engineering Company Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing a star, then 0 on your touchtone phone. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Harshit Kapadia from Elara Capital. Thank you and over to you, sir.
Good evening, everyone. On behalf of Elara Securities, we welcome you all for the Q4 FY25 and FY25 conference call of Elecon Engineering Limited. I take this opportunity to welcome the management of Elecon Engineering, represented by Mr. Prayasin Patel, Chairman and Managing Director, Mr. Kamlesh Shah, Group Chief Financial Officer, Mr. Narsimhan Raghunathan, Chief Financial Officer, along with their team. We will begin the call with a brief overview by management, followed by a Q&A session. I will now hand over the call to Mr. Prayasin Patel for his opening remarks. Over to you, sir.
Thank you, Harshit. Good evening and a very warm welcome to everyone on our Q4 and FY25 earnings conference call. I am delighted to be joined today by my colleagues, Mr. Ayush Shah, Non-Executive Director, Mr. M. Nanda, Head of the Gear Division, Mr. Kamlesh Shah, Group CFO, and Mr. Narsimhan Raghunathan, CFO. The press release and investor presentation have been uploaded to the stock exchanges as well as on our company website. I trust you have had the opportunity to go through the same. To begin with, I will provide a brief macro-level overview of the industry and the prevailing business environment, followed by a detailed review of our financial performance, which Mr. Narsimhan, our CFO, will walk you through. As one of the largest suppliers of industrial gear solutions in Asia, Elecon continues to be a leader in the organized industrial gear market in India. Internationally, our expansive distribution network spans approximately 95 countries, reinforcing significant presence of our global reach. Aligned with our long-term strategy vision, we are focused on increasing the contribution of international markets to 50% of our consolidated revenues by FY30. This global expansion is underpinned by our strong R&D capabilities and ongoing investment in product innovation. I am pleased to report that Elecon has successfully met with revenue guidance set at the beginning of the year, delivering a record-breaking revenue and EBITDA in both Q4 and full financial year. This milestone reinforces our disciplined execution and deep alignment with our strategic roadmap. Our business is anchored by two primary divisions, industrial gears and material handling equipment, each playing a distinct role into shaping our overall performance. The gear division, which contributes approximately 75% to Q4 FY25 consolidated revenue, has shown a stellar growth of 28.9% on a year-on-year basis, despite some sectorial headwinds in the earlier part of the year, largely due to softness in domestic demand due to elections and global macroeconomic uncertainties. The division recorded its highest quarterly revenue of rupees 597 crores, marking a significant reach. This resurgence has been driven by robust demand in both domestic and international markets, particularly from the steel, power, and cement sectors. While growth was moderate in the first 9 months, The strong finish of the year reflects the division's resilience and our ability to capitalize on improving market conditions. We are also encouraged by sustained strength in inquiry levels and market sentiment improvement. We see a strong pipeline shaping up for FY26. Our MHE division continues to exceed expectations, with FY25 revenue up 72.8% year-on-year and Q4 FY25 revenue surging 98.2%. This division is emerging as a prominent growing division for Elecon due to our focused strategy on developing this as a scalable business. This impressive performance is underpinned by a strong order book, primarily led by the demand from the steel and power sectors, followed by cement. MHE division's strong growth trajectory reflects the successful execution of our strategic initiatives, growing market demand, and our ability to deliver tailored solutions across industries. We remain confident that the division will continue its upward momentum in FY26 and beyond, backed by a healthy order book and a robust outlook across core sectors. Together, the solid recovery in the gear division and the accelerating growth of MHE division provide a strong foundation for Elecon's continued performance and long-term value creation. Elecon remains firmly focused on executing its long-term growth strategy. We are actively diversifying our business portfolio and expanding our presence across new sectors and geography. Our wide-range product portfolio, backed up by strong in-house R&D and engineering capabilities, continues to differentiate us in the industry. Looking ahead, we are seeing consistent demand from both domestic and international markets. Internationally, as part of the business strategy, we are actively pursuing opportunities to establish rapid build centers in Canada and Latin America, complementing our presence in the US and Europe. Domestically, core sectors continue to drive sustained capital investments, and we are strategically positioned to capitalize on this trend. Our strong order book, proactive client engagement, and the focus on customized, high-quality engineering solutions provide a solid platform for growth. FY25 has validated the resilience of our business model, and as we move into FY26, we do so with renewed confidence, supported by a clear strategy and robust execution framework. Sustainability is deeply woven into Elecon's DNA. This year, we achieved a major milestone with the approval of our near-term targets based from the Science Based Targets Initiative, SBTi, reaffirming our alignment with global climate goals. We are also proud to have recognized by one of our global clients in innovative and sustainable building solutions for our ESG practices, a testament to our transparent governance and operational excellence. These goals reflect our deep-rooted commitment to sustainability and our proactive steps to transition to renewable energy sources and reduce our carbon footprint across the value chain. Our ESG strategy extends beyond compliance. It is integral to our values and our approach to responsible business. We remain focused on driving positive environmental and social impact, fostering employee well-being, supporting community development, and maintaining highest standards of corporate governance. With this, I would like to hand over the call to Mr. Narasimhan, our CFO, for financial highlights for Q4 and FY25. Over to you, Mr. Narasimhan.
Thank you, sir. Good evening, everyone. A very warm welcome to our Q4 and FY25 earnings call. I will now take you through the highlights of our financial performance for the quarter and the full year ended March 2025. We are pleased to report that we have successfully achieved our annual guidance for FY25 alongside delivering the highest ever quarterly and annual revenue, EBITDA and PAT. We have exceeded our annual guidance by achieving 40 basis points higher EBITDA margins, reflecting strong operational efficiency and disciplined cost management. Financial performance Q4 FY25. For the fourth quarter ended March 2025, our consolidated revenue from operations stood at rupees 798 crores, reflecting a robust growth of 41.3% on year-on-year basis compared to rupees 565 crores in Q4 FY24. This resurgence has been driven by robust demand in both domestic and international markets. Overseas business remains healthy and domestic demand has picked up meaningfully, particularly from the steel, power and followed by cement sectors. The domestic market contributed 83% to the consolidated revenue, while the remaining 17% came from overseas markets. Domestic revenue in Q4 FY25 stood at rupees 662 crores, registering a growth of strong 48.8% on a year-on-year basis as compared to rupees 445 crores in Q4 FY24. Overseas revenue in Q4 FY25 stood at rupees 136 crores, registering a growth of 13.4% on a year-on-year basis as compared to rupees 120 crores in Q4 FY24. The order book visibility and heightened inquiries keeps us optimistic for higher growth in future. Consolidated EBITDA for the quarter was rupees 195 crores, up from rupees 135 crores in Q4 FY24, representing a solid growth of 44.3%. Consequently, our EBITDA margin improved to 24.5% compared to 24.0% in Q4 FY24, a 50 basis points improvement. This EBITDA margin improvement was mainly driven by a favorable product mix, improvements in after-sales services and operational efficiencies. Profit after tax for the quarter stood at rupees 146 crores, representing a 18.4% margin, up from rupees 104 crores or 18.4% in the same quarter last year. Financial performance FY25. For the year ended March 25, our financial performance remains solid. The consolidated revenue from operations stood at rupees 2,227 crores compared to rupees 1,937 crores in the same period last year, reflecting a 14.9% year-on-year growth. Our EBITDA for the year was rupees 543 crores compared to 474 crores in FY24. The EBITDA margin for the period stood at 24.4%, which is stable despite the challenges faced in certain sectors and markets in the first half of FY25. The PAT for the year was rupees 415 crores compared to rupees 356 crores in FY24, reflecting a 16.7% year-on-year growth. The PAT margin for the period stood at 18.6%. Segment-wise performance. The gear division contributed a significant portion of our overall revenue, accounting for 75% of the total revenue in Q4 FY25. For the quarter ended March 25, the gear division's revenue stood at rupees 597 crores, up by 28.9% year-on-year compared to rupees 464 crores in Q4 FY24. The EBIT for the gear division in Q4 FY25 was rupees 146 crores, up from 126 crores in Q4 FY24, reflecting a significant turnaround as compared to previous quarters. The EBIT margins declined to 24.5% in Q4 FY25 as compared to 27.2% in the same period last year, mainly due to the change in the product mix. The order intake for the quarter was rupees 497 crores, reflecting a healthy 20.6% year-on-year increase. As at 31st March 25, our order book stood at rupees 583 crores, positioning us for sustainable growth in the upcoming quarters. The Material Handling Equipment division delivered outstanding performance, contributing to 25% to total revenue in Q4FY25. The MHE division's revenue for the quarter was rupees 200 crores, up by 98.2% year-on-year compared to 101 crores in Q4FY24. This growth was driven by a strong demand in both the product supply and aftermarket segments. The EBIT for MHE stood at rupees 59 crores compared to 22 crores in Q4FY24, reflecting a significant growth due to higher demand of our offerings in the market. The EBIT margin surged to 29.6% in Q4FY25, up from 21.4% in Q4FY24, an increase of 820 basis points. This was primarily due to a favorable product mix and a higher contribution from the aftermarket business. The order inflow for the quarter stood at rupees 148 crores, up by 22.8% year-on-year compared to rupees 144 crores in Q4FY24. As at 31st March 25, the open order book for MHE stood at rupees 365 crores, reflecting strong demand and growth prospects. On the balance sheet front, we are pleased to report a strong cash position. Our consolidated net free cash surplus stood at approximately rupees 550 crores as of 31st March 25, providing us with significant financial flexibility to pursue growth opportunities and maintain operational resilience. The board has recommended a final dividend of 150%, that is rupees 1.50 per equity share, having face value of rupees 1 each, subject to shareholders' approval. As we look ahead to FY26, we are providing a guidance of rupees 2,650 crores in consolidated revenue with a EBITDA margin of 24%. This reflects our confidence in the continued strength of our business model, the resilience of our core markets, and the strategic initiatives we have put in place to drive growth. However, we are closely monitoring the global economic and geopolitical situation, which remains fluid. We remain committed to delivering value for our shareholders, and we are confident that our strategic investments, coupled with our focus on sustainable growth, will position us to achieve these targets and continue to strengthen our financial position. On that note, I would like to open the floor for questions you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Hearty congratulations to the Elecon team. Finally, the fourth quarter kind of made the worth the wait,
Thank you.
One question. Given the fact that our overall asset turnover is shy of 1 time, actually has fallen compared to last year, which was 1 time and is now at 0.9. That means our return on capital employed remains somewhat less ambitious a number than what otherwise one would look forward to in a quality engineering solution driven firm. So would like to hear your comments on that. How do we raise the bar on capital efficiency?
we started in putting in the capex, which has completed in March 2025. So the capitalization has happened in the fourth quarter. So that is the reason it is reflected in the way what we are looking to. But going forward, that will cover up what we are just seeing in the earlier period also.
So what kind of asset turnover, total asset turnover we can expect?
We can expect more than one asset turnover is expected going forward also.
More than one time?
Yeah.
So that means return on capital employed will be in the band of 21 to 24% if it is just one time or thereabouts. Which I thought, given the strength of our business, won't you think that that number could have been higher?
Yeah, but what we reflect, our number will always be conservative. As you have seen, we are always, cross what we are given the guidance also, in terms of our EBITDA margin and otherwise also. So our endeavor is always to improve than what we are estimating also.
But essentially, in the character of the business, what is the optimal asset turn we can expect overall?
What we just, the new machine have been started installing. So based, the efficiency may take its own time to settle down on the machines. And, based upon that, what you can see the, good asset turnover as well as the improvement on our return on capital employed, maybe from next to next year, that is from FY27, that will get reflected. See, all our machines are fully automatic and robotic machines. So you want to, and with the new technologies what we are investing in. So, it may have some teething issues, it may require some, more training and development for the operators who are operating the machines.
At that stage, do you think 1.2, 1.3 times total asset turnover is possible?
Yeah, it is achievable, honestly. So that will get reflected from FY27 onwards.
All right. Thank you.
Thank you. The next question is from the line of Akash from Dalal and Brocha Stock Broking. Please go ahead.
Yeah. Thanks for the opportunity and very strong set of performance, sir. So my first question would be to understand, what would be the impact of the US tariffs on our US business and also our other export business? Like, do we expect our US business to go down and will we recover in some other market, or how is it?
We are looking at the tariffs as an... Hello?
Hello. Yes, sir.
Yes, we can hear you.
Yes, sir. We can go on with the question.
Sure. Regarding the tariffs, we are looking at this as an opportunity right now. Though our order inflow is healthy from United States, they are also a hub for Canada and South America, which from now onwards we are planning that we will establish entities separately in Canada, in Mexico, and if required even in South America, so that they will be able to do the business directly without going through United States. This I would look upon it as an opportunity to further grow and expand our reach within the Americas. So I would look upon it as a great opportunity to do this.
Yes, sir. The current participant has been disconnected. We will move on to the next question. It's from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yes, sir. My question is on the gears division. So there is a deceleration in growth for the full year between this year and the last year. So this year we grew at about 5% in the gears business. So I just want to understand from a sector perspective, which of the sectors in FY25 would have done well, and which of the sectors would have been weaker for the growth to come down versus FY24? And I have a corresponding question linked to this, so if you could answer this first.
See, what had actually happened last year is the first quarter was slow because of the elections, and that is the reason the customers were not willing to take the deliveries of the gears and the products that we had manufactured. There was a bit of slowdown, and then there was an acceleration that happened later on because we were keen to reach our targets or get as close to our targets as possible. So which was the reason why we accelerated. The same thing happened in the order inflow also. The first quarter, in the beginning, the order inflow was slow. Okay, the pending orders were less, and then the acceleration happened in the second and third quarter, enabling us to further strengthen our requirements for execution of the orders. I can proudly say that today, as we talk about, our outstanding or pending orders in the gear are 365 crores, and in material handling, it stands at 583 crores. 583 in gears. I'm sorry, 583 in gears and 365 in MHE, totaling up to 948 crores.
So sectorally, let's say power, cement, steel, marine, off the shelf, which part would have seen the lower growth momentum, or any negative surprises in a certain sector versus others? If you could just comment there. We understood how it transpired during the year and reasons why it transpired that way. My question was the sectoral comments.
See, as I told you, if I tell you steel, it is a funny situation because it had slowed down and now it is again accelerating. So, you can blame it on steel for the time being, but it is showing a robust inflow of orders.
So, is it that the steel, so let's say your larger sectors are steel, cement, power, metal, marine, and off the shelf, your last 6 or 7 ones. In this, is it that the steel grew less than the material and the gear growth rate? So if your gear growth rate was 5%, steel grew lesser than this, or maybe declined. If you could give that way, the comment will be helpful.
Yeah, the steel sector compared to last year, there was a 6% dip in that, which was one of the major impactor on the revenue.
Contributors.
Okay. Yeah, correct.
Any other sector which had a lower performance or a lower growth rates?
No, rest of them are in the same line in terms of the percentage of growth. But only the steel sector, which was the, one of the contributors, which has impacted that also.
Now, when you are giving a growth guidance of 19% next year, which is higher than the growth of this year, what is the inherent assumption in this 19% growth number?
In that inherent is, my order book position as a 31st March, which is quite strong, and all these are executable in the coming year, even in the next year itself. Over and above, power is also going to contribute in a good way in the revenue driver for us.
Okay, so basically power is a sector which is a driver for growth next year.
Yeah, one of the major drivers.
Major drivers. Okay, any sector which you think is weaker in the coming year based on whatever you're seeing today?
Sugar seems to be weak as of now.
Sugar. Okay.
However, let us hope that we are wrong and it picks up momentum during the year, during later part of the year.
Okay, and just confirming, power means what? Basically, power means power generation side?
Thermal power.
Thermal power side. Okay.
Yes, power plants.
The steel, cement, so the 6 sectors which we mentioned, steel, cement, metal, power, off the shelf. If you could give a broader mix here, what was it in 25?
In FY25, steel was, in my total revenue of gear division.
Gears.
Yeah, I'm talking about the gear only.
Yeah.
So my steel sector contributed 11% of my total revenue. Sugar
11.
contributed 4%. Cement contributed 9%. Power contributed 12%.
Okay. And balance is off the shelf.
I'm sorry to interrupt.
Yeah, there are others also, like, MHE, then my marine is there, then engineering sectors are there, plastic and rubber and tire are there, then mining sector is also there.
Thank you very much, sir. All the best. Thank you.
Thank you.
Thank you. The next question is from the line of Akash from Dalal & Broacha Stockbroking. Please go ahead.
Yeah. Sir, I would like to understand if you could give a detailed breakup of the next year guidance. So of that 2650, how much we can are we planning to do in gears and how much in MHE? I mean, any ballpark percentage split you can give?
So we are expected 2,000 crore from gear division and 650 crore from MHE division. Both put together will contribute 2,000. Both put together will have the revenue of 2,650 crore.
Understood. And within gears, if you could give a split for domestic and export, I mean, how much we are targeting?
So presently we are not, but we are expected this my overseas revenue would touch nearly 27% to 30%.
Overseas will include both, right? The things that I export from India and plus what I do in the subsidiary.
Yeah, correct. Absolutely.
You said 27%, right? 27.
Yeah, between 27 to 30%.
Understood, sir. And one more question I wanted to ask, sir, was on MHE segment. So basically, on a quarter-on-quarter basis, we see the MHE orders dropping. And still, I mean, I think so you mentioned the 650 crore kind of a guidance for FY26 in MHE. So for how many further years do you expect such tailwinds in MHE to sustain?
Normally, the material handling business is on the rise because a lot of new power plants are likely to be tendered or ordered for, and therefore there is going to be a larger demand for material handling equipment. The orders are normally finalized in packets, so you may find that in a particular quarter there might be a surge or there might be a flat line during the other quarter. So that keeps on varying from quarter to quarter, but I am sure that overall MHE would be doing fairly well. As of now, the way the winds are, the tailwinds are helping us looking at things that they will be very, very positive.
Understood. So last question before I come back in the queue. How much is replacement business as a percentage of the total gears business we did this year?
Replacement business.
I'll give you the percentage. Just a minute. Exactly.
Yeah, for the year, 34% is the after sales service.
Thank you so much, sir. I'll come back in the queue.
Thank you. I would request all the investors to please limit their questions to 2 per participants, as there are several people waiting for their turn. The next question is from the line of Raj Shah from Enam Asset Managers. Please go ahead.
Am I audible?
Yes, sir, you are.
Okay. Thank you so much. My question is based on if you can provide any update on the progress with the OEM partnership, what kind of number have we achieved in this FY25? Hello?
Yes, just a second.
Okay.
Yeah. The major one, we got one OEM order this year.
In the quarter.
Yeah.
And in the last call, you mentioned, sir, that we will be able to clock around 50 crore revenue from this OEM partnerships in Europe.
Yeah.
If you can throw some idea, what would be the approximate number that we
So
achieved?
we crossed 58 crore for this year against our target of nearly 50 crore.
Okay. Okay. And how?
At the beginning of the year, we had given a projection of 25 crore, but later part in the Q2 earnings call, we said it is expected to touch the nearly 5 million plus euro, and we touched 60 crore rupees, I think, which would be nearly 6 million, 6.36 million euro.
And how do we see this number going ahead in F26?
Yeah, that we see a good improvement in this OEM business, and our target is also to tap more and more OEM business, so that one, we will have the sustainable growth in revenue, as well as going forward, considering the warranty period of the gear of 6 to 12 months, that will further generate after sales service business for us.
If I'm not wrong, this is entirely Europe business, right, sir? Or from US as well?
Mainly it is from Europe only. Only one is from Middle East.
Got it. One last question, sir.
I'm sorry to interrupt, sir. I would request you to please come back in the queue for further questions. The next question is from the line of Mayank Pandari from Asian Market Securities. Please go ahead.
My first question is on the...
Yeah, may I request you please be a little bit loud, please?
Can you hear me?
Still your voice is low, but better than the earlier. Can you just be louder, please?
Yeah, so my first question is on the margin side. As you have been guiding that next year your margin would be 24%.
Yeah.
So on this, what kind of segmental margin guidance you will give, like for transmission and material handling? Or maybe you can just highlight a sustainable margin in the material handling segment.
Yeah, material handling will have the sustainable margin of 23%, and gear division will have the sustainable margin of 25.5%.
25.5.
So overall, it will be 24% sustainable margin at a company at a consolidated revenue level.
Okay. And secondly, on this total revenue of almost 1762 crore in the transmission, what would be the composition in terms of standard and industrial?
Yeah, we had, the 60% is from the engineer product and catalog product, 40% for this Q4. And if I say on the total level, at the year, for the full year, 52% is from the engineer product and 42% is from catalog product.
And what is the guidance?
Mayank, I would request you to please come back in the queue for further questions. The next question is from the line of Hetvi from Catamaran. Please go ahead.
Hi, sir. Thank you for the brief. I might have missed this in the start, but can you brief a little bit more about the OEM business and strategy? Like, what sector clients are these? And last year you had mentioned that eventually we want the international business to be 50%, but right now the guidance is around 27 to 30%, which is what we had even this year. So just want to understand how we're thinking to achieve the 50% mark.
See, our reach in various parts of the world is continuously increasing. Our marketing aggressiveness is showing results. The orders may have come in ones and twos, but it is just the beginning. in various territories, new territories that we are looking for. And therefore, we believe that over a period of time, it will help us reach the 50% that we are looking for. Yes, the increase this year has not been substantial, but you have to also understand that there was a tremendous turmoil in the geopolitical situation all over the world, including in Europe as well as in the Middle East. So, which is also having a severe impact in various countries. Together with that, now we have Americas, which is again getting destabilized due to tariff wars which are going on. So all these are situations which are beyond the control of the business economy, and therefore you would see variations in what we have said. But overall, our strategy has been perfect, or I would say strong in what we believe, and it will give results over a long period of time.
Understood, sir. If I may just ask about the strategy, so which geographies would be of main focus, and among that, which what sector clients are we seeing interest from?
See, our trust has been in the Middle East, then also in the Americas, especially Canada and South America. And we are also seeing a good traction coming in now from the Far East.
From the Far East?
Yes. Far East.
But the revenue that we have clocked right now is from Europe, right?
Europe is always the primary, which is they are considering the OEM business and the sustainable business over there also.
Okay. And like,
I'm sorry to interrupt. Hetri ma'am, please join back the queue for further questions. Also, I would request all the investors to please limit their questions to one per participant, as there are several people waiting for their turn. The next question is from the line of Anish Jovalia from Girik Capital. Please go ahead.
Yeah, hi sir. Good evening. Congratulations for a very good performance in Q4 and a strong finish to the full year. So just wanted to have one question. One is your depreciation amount is now 19 odd crores and finance cost is 5 crores. So I believe there is some impact of the leased assets on this number. So if you could just help to understand in FY26, what will this number be between the depreciation and the finance cost? We don't have any debt. So if you could help, maybe there are other borrowing costs, etc. But if you could just help to understand these two line items for FY26.
That means that this year my full year depreciation is 50 crore rupees. And we are, the same we considering my operating lease method, what we are generally talking to everyone. So this year, in FY26, we are expected this to be nearly 70 to 75 crore for the full year.
So this will be the total depreciation of 70 to 75? I mean, sorry, I didn't get that.
Yeah, 70 to 75 crore for the full year, FY26.
Okay, and finance cost? Like anything coming in the finance cost from this line item?
Finance cost will be nearly 15 crore rupees for the full year. 15 to 16 crore.
15 crores.
Yeah.
Okay, so between the two of them, it will be around 90 crores. Right?
Correct.
Okay, sir. Thank you, and wish you a very good FY26.
Thank you.
Thank you. The next question is from the line of Deepak Puruswani from Swan Investments. Please go ahead.
Hello. Yeah, congratulations for the very good set of numbers, sir. Sir, my question is regarding the international market. I mean, if I were to look into the last year number, we grown at a 13%, and next year we are looking at a 27% kind of growth in this segment. So if you can just give some sense, which are the key segments which we are looking into it, and also I mean, in some of the OEM earlier we used to say, I mean, we are exploring 6-7 deals from the different OEM, and at what stage we are at in terms of the current discussion, and what is the revenue contribution we are expecting from these?
So still there are some of them are in the pipeline, and I think we are quite hopeful, it will be converted into the concrete order for us. And this year we have achieved that, from this OEM we achieved 60 crore rupees, which are from the different industries, starting steel, rubber, plastic, metal, and engineering sector, which are there. And going forward, the same kind of mix will be there from the other OEMs where we are going to engage in this financial year also. And our endeavor is also the same, we have to tap more and more OEM businesses from Europe and maybe from other part of the Western world. This should help us to make a sustainable growth going forward. And after that, maybe a couple of years after that, we may start generating more revenue as an after-sales service from that. Hello? Hello?
Yes.
Yeah.
The current participant has been disconnected. We will move on to the next question. It's from the line of Rishi Kothari from Pi Square Investments. Please go ahead.
Hello. Yeah. Thank you so much for the opportunity and congratulations on good set of numbers. Can you again let me know what exactly impact will have for the tariffs on us? I mean, is it beneficial? As you said, it will be a good opportunity for us to tap in the business. But can you just debrief us what exactly would be the benefit? How will it incur that benefit?
So, whatever consider the tariff in USA, which is applicable across the board, across the territories and countries. So far India is concerned, we consider that we are the sweet spot, but still we are not away from that impact on that also. So considering our business, growing more on Canada, Mexico, and Latin America, we are exploring to have our own setup over there. That is in Canada, Mexico, and Latin America, which will help us to directly supply from India over there and let them grow by itself so that I will not get impacted on the tariff side. And we are already at the very advanced stage to explore the same. And maybe in the Q2, we will have that set up from one or more territories what we are just exploring now.
So in a way, we are going more for geographical diversification. That is, apart from US, we are exploring more of an areas like Canada, Mexico, Latam, and all that.
True. And as far as USA is concerned, while we would be subject to additional taxes, so would our competitors. So it would kind of nullify the situation. So the difference in tariff between various countries would not be more than 2 or 3%. So which is easily bridgeable. So we are not expecting, a severe difference in pricing because of this.
So presently what we are doing the business from USA to this territory, that is Canada, Mexico, and Latin America, that now we'll do directly instead of routing through US our manufacturing setup over there.
Okay, got it. So in a way, in terms of US tariff, we say the initial cost increase will be hardly 2 to 3% on other products that we supply to them, right?
Correct.
No, the difference in tariff between us and our competitors from other nations would be 2 to 3%.
Okay, so 2 to 3% we are advantageous compared to other countries to the US.
Advantageous or disadvantageous.
Okay, so delta difference.
Sorry to interrupt, Mr. Rishi. I would request you to come back in the queue for further questions. The next question is from the line of Manish Goyal from Thinkwise Wealth Managers. Please go ahead.
Thank you so much. Just to clarify, on the depreciation number, you mentioned 75 crores versus 50 crores. Is it on the standalone basis, right?
Yeah, correct. Standalone. Because my major CapEx is in India only. That is at the standalone level only.
So, and also, so if you can just provide clarity, like what is the absolute CapEx in FY25 and what will be in FY26? And secondly, what I see in your balance sheet is that lease liability has increased significantly from 44 crores to 147 crores in standalone, and similar jump is seen in the balance sheet. So now, what is this lease liability pertaining to? Because is it particular to asset addition or what, if you can clarify? And if we take this combined effect of CapEx outflow and lease liability, what is the kind of capacity we are creating on revenue generation front? Just want to get a sense on these numbers. Thank you so much. And also one more question. What was the export revenue from India and how has it grown and how do you see it growing? Because you give the international number, but how much is exports from India? Thank you.
So this additional lease liability is nothing but an addition to the CapEx. So what we are adding what we have projected the last 3 years, the CapEx addition of 300 crore, which is going to generate the additional revenue of 500 crore for us.
So why is it? So what is that? So when you say lease liability, it is probably we have probably taken some assets on the lease, and then what is the actual CapEx which we are doing? Because that number in the cash flow statement is roughly 65 crores. So what is the absolute CapEx you will be doing when you are saying 300 crores? Does it include lease liability also, or it is excluding that?
No, it includes the lease liability also. But when the cash flow is, because cash flow is prepared as per the India's guidance. So in that India's guidance, that lease assets are not covered over there also.
Okay, I will take this off.
Yeah, and there's sorry. Yeah.
We will move on to the next question. It's from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Thank you so much for the opportunity. I just wanted to ask on the employee expenses. We're seeing a huge uptick this quarter, especially in the standalone. Are these at sustainable levels, or is there a one-off in this quarter?
No, these are our sustainable revenue growth only. Whatever the numbers are, it is sustainable for us.
I meant employee expenses, actually.
Pardon?
Employee expenses. So the employee expenses are much higher this quarter.
Yeah. Generally, we also have to increase some employee, particularly more on the business development side as well as on the R&D side also, which is what is reflected. So whatever the new additions to the employees are there, it is mainly on the productivity side only, that is in R&D and on the marketing side, which is now required considering our growth trajectory, what we are looking for over the period of time. And it is increased because there are always a fixed pay as well as the variable pay are there. So variable pay is always considered through our certain parameters of our financial parameters to give to the employees, and that is how it is reflected.
Okay, thank you so much.
Thank you. The next question is from the line of Pratik Khotari from Unique PMS. Please go ahead.
Yes, hi. Good evening and thank you. So one comment on Elecon, the press release which you have put out. I mean, what is happening? You mentioned it won't be an associate anymore. So I understand that the tripartite agreement is being broken, but are we also selling our stake there?
No, Pratik, considering the SEBI guidance, associate when we terminated our agreements with the Sandvik Group or Tamrock UK, so we are now nowhere. Earlier we were the part of the shareholders agreement, and that is the reason Elecon Emco was considered as an associate company because of that agreement on. So now that agreement doesn't exist effective from 23rd of April. So my stake will continue because to be an associate company we must have the holding of more than 25% on that. So as my holding is remained less than 25%, this will not be considered as a associate company. That is the only change, nothing else. It is just a classification of my investment. There is no other impact so far as my holding is concerned. We have no plan to add anything so far as the holdings in the Elecon, as well as we do not have any plan to offload our existing holding of 16.66% in the market or otherwise.
Okay, great. And sir, in light of the opening remarks by the chairman or the guidance that we have, the order book that we are seeing, I mean, when we look at it, it's only 65 crores this year. I believe we are also adding capacity through this lease route. So one, qualitatively, I mean, be it on the employee side, be it on the capacity, machines, plant, etc. I mean, are we investing enough given the opportunity that we see? I mean, we also see that we will be benefit out of this tariff issue which is going on. One, are we preparing enough for it, and have we invested enough? Just if you could share your thought process to capture what you have come.
Pratik, we have invested nearly 160 crore in this year, nearly. Generally, lease assets, which are considered as a right of use assets in the fixed asset, which are not reflected in the cash flow. You can see the note which is given in the cash flow statement. As per the Indian accounting guidance or guidelines, that lease assets are not reflected as addition or the deletion to the assets. And we have planned ourselves very well so far as the capex plan is concerned, considering the lead time of the machines for the delivery as well as the revenue projections from the marketing department. And we don't foresee any challenge so far as the capacity is concerned or any capacity constraint to manufacture and provide the timely delivery of our goods to the customers.
Right. And then lastly on dividends, I mean, 10-15% of profits we generated is being paid out as dividend. I mean, our capex plan also is not very high. I mean, 100-200 crores a year. We have now enough cash on books. So if you can share, in this dividend be ramped up, what else are we thinking? How do we plan to spend the cash that we are generating?
We have already calculated, and as per our dividend policy, we have declared the dividend. And because while presenting the my dividend proposed dividend to the board, we are considering the different parameters to declare the dividend. And I think this time you might have seen we have increased our dividend by nearly 50% per share. So that also is the good start. As we already started from the last year to improve my dividend outflow. And this year, that the same is reflected by increasing my dividend this time. That is 200%, including the interim dividend of 50%. And going forward,
cash that we have, I mean, X of capex, X of dividend, which is currently sitting on our balance sheet, what potentially can come out of that?
So that, because we also have to keep some, considering my global business, so we have to keep some amount, which may be a material amount for my contingency also, like this, the geopolitical changes and different kind of threats what we are expecting. And at the same time, we have to keep certain, cash available for us for the capex also. Though we may explore the alternate options to do the capex, but I have to keep that money reserved with me also.
Let's put it this way, that this is a war chest which has been created for any opportunities which come our way in the near future.
Thank you, sir. Ladies and gentlemen, due to time constraint, that was the last question for today's conference call. I would now like to hand the conference over to the management for closing comments. Thank you.
In closing, I would like to thank you all for joining this call and for your continued support to Elecon Engineering. FY24 has been a landmark year for the company. We are encouraged by the strong growth momentum across both our gear and MHE divisions. The gear division has demonstrated a solid recovery with robust demand across key geographics as well as other sectors, while the MHE division continues to outperform, driven by healthy and diversified order book. Our consistent execution focus on high growth segments, disciplined approach positions us well for sustained performance. As we move into FY26, we remain fully committed to scaling new heights, strengthening our leadership across markets, and delivering long-term value for our stakeholders. We don't merely provide solutions, we shape the future of industrial gear technology. Thank you once again for your participation and trust in Elecon Engineering. If you have any further questions or inquiries, please do not hesitate to reach out to our Investor Relations Advisor, SGA, or our CFO, Mr. Narasimhan Raghunath. Thank you all.
Thank you. On behalf of Elecon Engineering Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.